Good morning, everyone. We're going to start the video this week by taking a look at a few of the trades that we've got on at the moment, a few of the things that are going on. We're going to start with euro pound, and we'll also cover dollar yen and what's going on in oil. So three things to focus on today. Right, let's start off with euro pound and see how that's been getting on. Okay, so just to bring you up to speed with that. Obviously, what we were covering there is the euro pound trade based purely on the speed of vaccinations and the rollouts there, which obviously the EU have completely boosted up. They have been very slow in getting the vaccines out, and as we can see here, this was back on the 28th of January. This has just continued now. The UK and the US are well ahead of Europe, and the growth dynamics there are much better. So they're looking at herd immunity potentially in the UK for around about the 14th of July, early August for the US, and the EU not until the 21st of October. So what we looked at there on this this trade idea, euro pound, we were the 28th. Let's just get the crosshairs up now. Okay, so we were trading up around this level here on the 28th, 88.60s. Obviously, what we've seen since then, just gradually grinding lower as the pound shown its strength, euro shown weakness, and we're looking for this to continue. If we zoom out slightly there, bring it out to the daily chart, I don't think it's beyond the realms of possibility to see a move down to this level here at 86.71, presuming everything continues along the same lines. So that's the euro pound trade. We also looked at dollar yen. Okay, obviously we were talking about the dollar, the death of the dollar that we see bandied about every couple of months. It was along the same lines, short positioning very extended at the moment, still in the dollar. And again, we're looking at the dynamic there where we've broken out of this channel. See this here in dollar yen. So again, this one was sent. When did we send this out last week? Which day? February the 4th. So we've seen this since last week. It's pulled out into this this area that I identified up here. Okay, so in and above these highs here, we just tagged them. We sold off a bit, but it looks like we still want to push on a little bit higher. Really test these dollar bears just slightly more. I still think that a move up towards 106.11 could be on the cards, and then we could potentially see it come back down, maybe test the outside of this level here, this sort of 104.50, maybe even slightly lower back into this area here at 104, 103.90s. Once the dollar downtrend resumes. And then also just to look at one more we covered was, is Biden bullish for oil? Now, potentially over the longer term, we would argue that he is, because of some of the sort of climate policies and everything he wants to put into place. But at the moment, the sort of risk reward doesn't really favor getting long at this point in time. Okay, so the reason why we're saying that is if you look here, okay, so this is a weekly chart of crude oil futures from month ahead, and on this basis you can see not just because of the trend line. The trend line is a nice bit of confluence, but you can see we've been in this downtrend and we're now approaching this trend line here. So whilst that's going on, we're seeing OPEC delivering, and Russia's bringing some of their supply back online. And what we've seen historically is a difference between the two main players in this really are Saudi Arabia and Russia. So the big fall off in oil prices that we saw back here, aside from the pandemic, was also a price war between Russia and Saudi Arabia, because they couldn't agree on what to do with the falling demand. And that led us to see this move, this spike here, where we actually went into negative prices, as you can see. So as we're moving on with that, what we want to look at, just going to change this over here. So what we want to see, or what we're likely to see now, is this sort of alliance tested. because Russia has been allowed to bring some of this supply back online. They were given a bit of a pass in the last meeting. Saudi Arabia was allowed to, or was basically decided to cut their production to try and keep prices higher. Now, what we're looking at here with Russia and Iran as well, and Venezuela, is they're all Iran and Venezuela are under sanctions from the Biden administration, as you can see in the text here. And Russia really want to try and grab market share as well. So everyone here has got this idea that they want to reclaim market shares. They want to up their output, while people like the US industry, for example, the US shale industry is under pressure. They're going to struggle to bring it back online at the same sort of pace, and they want to try and grab the market share while all of that, while the US is coming back on, getting drills back in the ground, and really trying to recover from the shutdowns they've had to put into place. While Saudi Arabia, on the opposite side of things, they would actually prefer to keep the production steady, keep it restricted so that they can boost the barrel price, so boost the actual price of oil. That's really where the conflict is likely to come, and I think the traders will start anticipating this dynamic ahead of the next meeting, which is due in about a month's time, just slightly less, where we could see this difference here between Saudi Arabia and Russia lead to greater output, and potentially some of the other nations as well, and obviously Iran, very much in their interests to try and should we say build bridges with the Biden administration. And as you can see here as well, they're already targeting 2.3 million barrels per day of exports if the sanctions are lifted, and they've already ordered them to begin increasing production. They're domestic oil operators. Bring them back up towards the pre-sanction capacity. Obviously 4 million per day, still a way to go. But with that, obviously all of this basically brings more supply to the market, whilst demand is still being suppressed, shall we say. And it's a long way to go before we can really look at the oil market as being excessively bullish again. So I think we'll get a pullback in the oil market. We'll have to look at the dynamics as they evolve on that. But really, that's what we're main things that we're looking at the moment. One other thing that's really on the radar is the inflation expectations and their influence on the US yields. I get a bit technical, so obviously stay with us on this. I'm just going to change that to a line chart. It looks a bit clearer like that. So I want to bring this onto the screen here. Okay, so this is a chart from Westpac where they're looking at the US 10-year bond yields. What we've got here is the real yield in black. Okay, that's obviously at the bottom there. We've got the nominal yield in red and the break-even expectations, 10-year break-even expectations here in purple. So there's a big divergence here between, obviously the real yield is what you get when you take away the actual treasury yield, so the nominal yield from the actual recorded inflation. So it's your inflation adjusted return on bonds. That's hardly moved, but what has moved, as you can see by the break-even inflations, is this expectation that inflation is coming. Now, what that will likely lead to, it's obviously led to higher yields, and what we're likely to see going forward is that narrative kind of tested now, and what that could mean for the price of gold as well. If these real yields don't move down the bottom here, and we don't actually start seeing the inflation filtering through, then that's still kind of a good scenario for gold. If we do start seeing actual inflation coming through, then the real yield is going to push back up towards zero, and people will be questioning keeping their money in gold, especially if that goes alongside a rise in the nominal yield, so the red line here, because you can actually earn a return obviously on the 10-year bonds then, even when adjusted for inflation, whereas gold obviously sits perfectly on this zero line at all times, and only moves together with actual market prices. So really those are the things we're looking at today, the three main themes, what we're looking at for this week, and potentially even the weeks ahead. It's not a fast moving macro environment at the moment. We can see that 10-year yields are sat right on this 120 level, which is the highest they've been at for quite some time. The US 30-year also just below 2%, so that will be something to really watch going forward.